Welcome back to Financial Fitness. I have my Philip Board here, the co-host.
Mia Medina.
Nice to see you, Mia. And Kurt's back joining us again as well.
Kurt Mosley here. Thank you.
Thank you, Kurt. So let's talk about like investing 101. So what are some of the terms that someone new to working with a financial advisor, they might know some of it, but let's qualify it. So you got some terms that you think that we should cover?
Let's see, retirement accounts, non-qualified, qualified, 401ks.
Okay.
Taxable, non-taxable. Things like splitting those up into two different categories so people understand what those are.
Okay. All right. Kurt, do you have any thoughts?
Yeah, a lot of people, what's very common for most people to have is a 401k. And how's your 401k structured? Is it just a standard 401k where you only have one type of investment option, which is pre-tax money? Or do you have the option to put money inside of a Roth inside your 401k?
All right. So how about even more basic than that? Like, what is a mutual fund, a stock, a bond, and an ETF? Right?
Can all registrations or retirement accounts and non-retirement accounts have all of them?
Oh.
Right? Sometimes people think they are only held in one specific type of account.
Okay. So let's break this down. So let's start with what's a stock, what's a bond, a mutual fund, and then ETF, right? So what is a stock, right? Stock is ownership in a corporation. What that basically means is that you give a corporation some money, they give you some shares. And if the corporation does well and it grows in value, then your shares increase in value. Conversely, if they lose money, you lose money. So that there is some risk in that, right? Hopefully there's more companies that go up than go down, but that's a stock. It's ownership. And if the company goes belly up, you get nothing, right? So what is a bond? A bond is lendership. You're essentially lending money to a corporation or an entity. So let's say a municipality or a bank or even a corporation. And you're going to give them in $1,000 increments. You can give them the bond money. They're going to pay you an interest over a period of time. And at the end of that period of time, they're going to give you back your $1,000. So it's lendership. If the corporation goes under, you are number one in line to receive your money back. Conversely, the stock, you're last in line. So there's a difference between the two, right? So that's a stock and a bond. And pretty much everything we do in the financial services world revolves around those two things. So the next thing is, what is your mutual fund? Is it different? A little. But let's take, for instance, if you wanted to buy shares of Tesla and you want to buy a round lot of Tesla, it's going to cost you about $70,000. That's 100 shares at $700. I don't know what the price is today, but somewhere in that neighborhood. So that's a lot of money. Well, whereas a mutual fund, it would be that Kurt throws in a few thousand, Mia throws in a few thousand, I throw in a few thousand. The fund manager is saying, we're going to buy a little bit of Tesla. We're going to buy a little bit of Apple, a little bit of whatever the fund mandate is. So you get this diversification process. So you're not having all your money exposed to one company that could go up or down, right? So a mutual fund is a way for many people to get to a lot of different companies that they wouldn't be able to buy if they bought on their own. And the other nice thing about mutual funds is I think some of them, the minimum investment is $500 to start, and you can do $100 a month. So it's a great way for a new investor to start, right? Now you might have heard something about an ETF. That stands for Exchange Traded Fund. What that is essentially there's, and let's call it an index. An index would be like the S&P 500 or the NASDAQ 100 or the Dow Jones. Those stocks, there's no management involved with those stocks. It's just a bucket. And you buy shares. So stocks are traded daily throughout the day when the market is open. Bonds are traded daily throughout the day when the market is open. Mutual funds only trade at the end of each business day. ETFs are much like stocks and bonds, and you have the makeup, if you will, of a mutual fund without the active management, but they trade like stocks and bonds. So the liquidity is much higher and they're cheaper to own. So those are the 4 types of investments that are essentially out there. There's a few others, but those are the basic ones that anyone new to investing should know. The next part of that is, can I own a mutual fund in an IRA? Can I own a mutual fund in an after-tax account, right? So Mia brought up the different types of accounts. So all of these investments can be owned in any type of account. And you might hear your advisor talk about qualified or non-qualified. The word qualified is tax qualified. So a qualified account would be your 401ks, your IRAs, Roth IRAs, something where there's a tax component associated, right? Then the non-qualified accounts, these would be your brokerage accounts, your joint accounts, your trust accounts. Any of those things are held either directly or indirectly. So you've got 2 different types of tax qualification, and there's a list of accounts that go in each one of them. Beyond that, is it a brokerage? So for instance, E-Trade would be a brokerage, or Schwab is another brokerage. Some mutual funds you can buy directly, whether it's Fidelity or American Funds or Invesco. You can buy them directly with that, but then all of the different categories of of accounts apply, right? Anything to add to that?
I think you mentioned you can buy all those types inside of any type of account. Not necessarily true specifically for your 401k. Your 401k might have limitations. What does the plan allow? Is it what's called a self-directed brokerage option? So if your plan has that SDBA option, you have a lot more options as far as what you can put inside your 401k. A lot of 401ks are set up very quick and simple, where they might have a list of target date funds or some mutual funds inside of your 401k that you have to pick from, but they can be limited. So, be cautious on what does your 401k allow you to do.
Yeah.
So having that knowledge, what can you do? A lot of people. Oh, go ahead.
Yeah, no. Excellent point, because like target date funds, right? We see them more often than not. I don't think the general public out there truly understand what a target date fund is. Target date fund is, and oftentimes you're auto-enrolled in your 401k. You got a new job, you're auto-enrolled, and they put you in, based on your age, a target date fund. And for the most part, those target date funds are your portfolio. You're set to retire at 65. So therefore, if you're 50 now, you're going to have a portfolio that's more bond than stock, right? But what that doesn't take into consideration is what kind of investor you are. It doesn't take into consideration what other assets you have, right? Maybe you've got an entirely huge bond portfolio over here. So why do you need more bonds in your 401k when it's a newer account? You might want to go significantly more aggressive. So age-based funds change. So Mia could have an age-based fund, and as over the next 20 years, it will gradually become more and more conservative, whether she does anything with it or not, regardless of outside assets, outside investment. So good and bad for everybody. What we see quite often is people working past the age of 65, and now their accounts aren't growing because they're all in bonds when they should be taking income, right? So there's that.
I have a thought.
Okay.
You did mention that you could hold the different stocks and bonds and ETFs sometimes directly, or brokerage account, right?
Yeah.
I think the one thing is, like, if they want to own multiple mutual funds or a combination of mutual funds, stocks, and ETFs, it's best if they just hold it inside a brokerage account where you could do more rather than directly. Once you buy, say, a mutual fund through a fund family, you would have to open up a brand new account if you want to change the different investments inside of it. What do you see other advantages of or disadvantages of just holding them directly, or as opposed to a brokerage account?
I do love your comment on the brokerage account. And I would agree with that. The disadvantage to holding them directly is if something happens to you, Now your beneficiaries have, or your heirs have multiple places to go to try and deal with, to pull this money in, versus a brokerage account. You can hold so many different things in there that it's just a one-stop shop. So there's excellent point. That would be my choice as well, because you can do some ETFs, some bonds, some stocks, some mutual funds. It doesn't matter.
You have
But,
more options.
You have more options, and it keeps it cleaner. So there's just less paperwork. And one of the complaints,
Diversification as well.
Huh?
Diversification.
Yep. And you can see it in one spot. One of the complaints we hear from a lot of our clients is we're in this world where they have to be notified, full disclosure, and the amount of mail they get. And our bigger clients, unfortunately, the more money they have, it becomes slightly more complex. Not that we're doing some sophisticated investments. It's just they have more accounts. They've got IRAs, they've got Roth IRAs, they've got brokerage accounts, they've got all kinds of stuff. So it just becomes a lot more convoluted, and managed accounts. They're all over the place. So one of the other things I think we run into quite a bit is a term RMD, required minimum distribution. And our illustrious government has been making that a moving target recently. For 26 years of my career, it was 70 and a half, period. The year in which you turned 70 and a half. It was very simple. Why 70 and a half? I don't know, but it was 70 and a half. They changed it to 72 for 1 year. It's currently 73, age 73. And when does it go to 75, Kurt?
2032 or 2033.
Okay,
it's 2033. It goes to 75.
So in 8, oh my gosh. And so it's going to 75. It keeps on moving. And what is an RMD? So RMDs only apply to retirement accounts. So that would be your IRAs, 457s, 401ks. Those are pretty well lit. Your Roth IRAs don't fall into this rule. But anything that you've not paid taxes on, that is money that you've put into an account before you've paid tax on it, is subject to this rule. And I used to know the table pretty good. At 70 and a half, it was about 3.3% of whatever your account balance was at the end of the prior year. So December 31, and you'll see this on statements now. It'll be your required minimum distribution value, and it was the value of your account on December 31. So this is where having a team in place really matters, because it's something that we track for all of our clients across all of their accounts, which is a huge undertaking. But if you're a solo advisor, the chances of you being able to do that effectively it's a lot of time away from actually advising your clients. So yeah, RMDs.
Yeah,
that's kind of a big deal.
Keeping up with what's changing with them, right? During COVID, they suspended you having to take RMDs for a year. So that made it even more complicated for, okay, did you just turn 70 and, 70 half, 72 inside, during that time when you didn't have to take an RMD, when do you have to take it? And then, if you leave a qualified account to an heir who's a non-spouse, how quickly do they have to liquidate it? Knowing that. Also, if you're still working and contributing to it, you don't have to take the RMD. There's certain rules, knowing how all those fit. It is very complicated, and just, okay, well, do I have to take my RMD or not?
Yeah. So we see that with our senior clients. Obviously, those in their 70s are asking a lot of questions around that. So we've covered what's a stock, what's a bond, mutual fund, ETF. Those are the basics. There are plenty other investment vehicles out there, but we're not going to cover them on this one because this is our investing 101, if you will. And we've also covered some basic accounts that you may be familiar with. So again, qualified, non-qualified. That means non-qualified means it's an account that you've funded with dollars you've already paid income taxes on. Qualified is an account that you've funded with money that you haven't paid income taxes on. So those are the two differentials. And then your IRAs, Roth IRAs, 401ks, 457s. On the qualified side, brokerage, individual transfer on death. That's another one. That's a That's a designation for an after-tax account that puts a beneficiary on it for you. Hope you found today's content interesting. By all means, like and subscribe. You can also listen to us on all the popular streaming platforms, Apple, Spotify, you name it. We're on all of them. Look forward to hearing you there too. Thank you.